You know, for years, the story of African fintech was pretty much all about one thing: the incredible leapfrog success of mobile money. But that story is changing, and fast. We're now entering a whole new, more sophisticated phase, what we're calling Fintech 2.0. And this era? Well, it's being defined by mature capital, financial services that are basically invisible, and the digital integration of an entire continent.
So, here's what we're going to break down in this explainer. We'll start with the massive $4.1 billion rebound in tech funding. Then we'll dive into the battle of the innovation hubs heating up across the continent. After that, we'll get into the invisible revolution of embedded finance, see how new kinds of data are finally unlocking credit for the unbanked, and wrap up with a look at how technology is forging a borderless financial future for Africa. All right, first up, let's follow the money. After a pretty tough global slowdown, the African tech ecosystem has come roaring back. But the way capital is flowing now is fundamentally different, and that tells us a whole lot about how mature the market is getting, and really about the dawn of this new Fintech 2.0 era.
So there it is, the headline number. $4.1 billion in combined equity and debt financing landed in 2025. That is a 25% jump from the year before, which just shows you how incredibly resilient this ecosystem is. But honestly, the real story is what's inside that number.
Okay, this chart right here, this is where things get really interesting. It shows a huge shift. For the first time ever, debt financing makes up a massive 41% of all capital. Now, this isn't just some small adjustment. It's a structural transformation in how African companies are choosing to grow.
I mean, a 63% year-over-year explosion in debt. That's huge. So why does this matter so much? Well, it signals a whole new level of maturity. It means companies with predictable revenue can now get their hands on large-scale capital without giving up more ownership. They can scale their businesses without diluting their equity, which shows a ton of confidence in their own cash flow.
And you can see that maturity showing up in another way, too: consolidation. 2025 saw a record 67 M&A deals. The old growth at all costs era, that's over. What we're seeing now are smart, strategic moves where stronger companies are buying up others to build more resilient, integrated businesses. The market is getting organized, and that's another clear hallmark of a maturing ecosystem.
So we've talked about the what, the money. Now let's talk about the where. The story of African tech has always been driven by these key city ecosystems, right? But the competition between them is really starting to heat up.
The big four markets, no surprise, still dominate. But just look at the rankings. Lagos is holding on to that top spot in Africa, coming in at 76th globally. Cairo has been on a truly remarkable climb, now at 90th. Nairobi is solid at 107, really anchoring East Africa. And then we have a major shakeup happening down in South Africa. Yeah, here's the big headline. Johannesburg is on an absolute tear. With a growth rate of over 42%, it has officially overtaken Cape Town to become South Africa's #1 startup hub. This isn't just a small shift either. It reflects this powerful new momentum in the country's economic heartland, and that could have huge long-term implications for the whole region.
And you've got to admire Cairo's consistency here. This wasn't a one-off jump. The city has climbed the global ranks for 5 years straight, finally breaking into that top 90. It's cementing its position as the undisputed leader of the North African tech scene, with a score that's more than 7 times higher than its closest competitor. Just incredible momentum.
Okay, let's switch gears and talk about one of the most powerful trends bubbling under the surface of Fintech 2.0, the rise of embedded finance. This is where financial services start to kind of disappear, becoming a seamless, invisible part of the other apps that we use every single day. So what does that actually mean in the real world? It means your ride-hailing app can offer you a loan on the spot. Your favorite shopping site gives you a buy now, pay later option right at checkout. Your logistics platform offers insurance to the small businesses using it. Basically, the bank is no longer a place you have to go to, it's a utility that comes right to you.
And the scale of this is just enormous. This so-called invisible market is projected to be worth $18 billion by 2030. It's all about moving from standalone fintech apps to a world where every platform can become a fintech platform, solving real problems for people at the exact moment they need it solved. This has the potential to dramatically boost financial inclusion and economic activity. And that leads us perfectly into one of the biggest challenges in Africa: financial exclusion. For decades, the question has been, how do you bring hundreds of millions of unbanked people into the formal economy? Well, Fintech 2.0 has a really fascinating answer. So let me just ask you this.
How do you figure out if a street vendor in Nairobi or a small farmer in rural Nigeria is a good person to lend to? They don't have bank statements. They don't have a credit score. By all the traditional metrics, they're completely invisible to the financial system.
The solution is something called alternative credit scoring. Instead of looking at bank history, fintechs are, with user consent of course, analyzing the digital footprint we all create, this thing called our digital exhaust. Think of it like a digital resume that you're constantly updating without even trying. This data creates a rich, real-time picture of someone's reliability that a traditional bank could just never see.
So what exactly is this digital resume made of? Well, it's stuff like how long you've had the same phone number. That signals stability. How consistently you top up your airtime. That can be a proxy for cash flow. Even your mobile money history and how consistent your location data is. All of it can help build a highly predictive credit profile, getting loans approved in just minutes.
All right, so let's zoom out. We've talked about the individual, now let's look at the entire continent. For Africa to truly reach its economic potential, it has to solve the massive friction that exists in trade and payments between its 55 different markets. And this is where technology is building some incredible new bridges.
Just take a look at this comparison. It's staggering. To send $200 across a border in Africa the traditional way, it costs nearly 8% in fees and can take up to a week. Using blockchain-based stablecoins, that same transaction costs about $1 and happens instantly. This isn't just a small improvement, it's a revolutionary change for trade, for remittances, for business.
And this whole revolution is being supercharged by a crucial piece of public infrastructure called PAPSS. Think of it as the new payment highway for the entire continent. It lets countries trade directly with each other in their own local currencies instantly. This gets rid of the need for costly conversions into dollars or euros, which has always been a major hurdle. It's projected to save the continent $5 billion in transaction costs every single year.
So, let's pull all these threads together. We've seen a massive shift in capital, a fierce battle between innovation hubs, an invisible revolution in how services are delivered, and the construction of a truly borderless payment system. This is what defines Africa's Fintech 2.0.
And it really rests on 4 key pillars. First, there's mature capital. The ecosystem isn't just relying on venture equity anymore, it's using sophisticated debt and strategic M&A. Second, embedded utility. Finance is becoming a seamless feature, not a separate place you go. Third, data-driven credit. Digital footprints are finally being turned into economic opportunity for millions. And last, regional integration. The digital rails are being laid for a truly unified African market.
And that leaves us with one final, pretty fascinating question. For years, we talked about Africa catching up. But as the continent builds these new systems from the ground up, completely unburdened by old legacy infrastructure, you really have to wonder, is Africa now building the blueprint for what digital finance is going to look like for the rest of the world?